On February 8th, 2026, Japan is going to make a decision on money printing, and that decision is going to impact not just the Japanese economy, but the United States dollar and the U.S. stock market. If you're an investor, you need to pay attention to this because Japan is the largest foreign owner of U.S. dollars, and the Japanese economy has been struggling. And that's a problem because if they're forced to sell those U.S. dollars, that will obviously hurt the value of the U.S. dollar. That will push inflation higher, and that will flow straight into the U.S. economy. But to understand what's coming on February 8th with the Japanese economy and money printing, you have to understand how they got into this situation in the first place. Because Japan hasn't been dealing with an era of inflation. They've been dealing with an era of deflation. Now, we all understand inflation. Inflation is prices going up because the value of the currency is going down. Deflation is the opposite. It's prices falling. And yeah, that sounds good if you're a consumer because the $100 you have sitting in your bank buys you more stuff over time. But it's not good for the government and it's not good for the economy long term because asset prices fall, spending slows down, growth gets weaker, and people delay big purchases because they expect things to be cheaper later. So, for years and decades, the Japanese government has been trying to stimulate their economy with things like money printing and extremely low interest rates. And when I say low interest rates, I'm not talking about 1% interest rates, and I'm not talking about 0% interest rates. I'm talking about negative interest rates. This is a weird concept, so let me break it down in a way that actually makes sense. We all understand positive interest rates. I borrow $1,000 from you, and I pay you back $1,000 plus interest. Maybe $100 of interest, so I pay you back $100. Negative interest rates are different. I borrow $1,000 from you, and I pay you back $900. You literally lend money and get back less than what you gave. And you're probably thinking, why would anybody ever agree to that? Two reasons. Number one, if you're going to lose less money by lending it at a negative interest rate than you would by putting it somewhere else, you choose the option where you lose the least. But number two is the bigger one. The largest lender to the government of Japan has been none other than the Bank of Japan, their central bank. So they were fine taking losses on these loans because they're the central bank. If the government wants them to keep the machine running, that's what they do. And for a long time, they justified it because they were battling deflation, not inflation. But now that has changed because all that money printing and all those negative rates have finally caught up. Japan now has an inflation problem, not a deflation problem. And that matters today because now the government of Japan is trying to decide what they're going to do next. The prime minister and the government want more money printing. But in order to do that, they need approval on February 8th to move forward the way they want. And if they don't get that approval, they won't be able to print money to the same extent they're planning. Either way, this decision will shift Japan's interest rate path, and that will hit global markets, especially the U.S., immediately. And here's why. The first reason is something called the yen carry trade. Japan has had the lowest interest rates of any developed country in the world. For a long time, you could basically borrow money for close to zero. So what Wall Street institutions, banks, and investors have been doing is simple. They go to Japan, borrow yen for essentially free, and then they take that money and dump it into assets in the United States. Stocks, crypto, real estate, anything with higher returns. Because if you can earn 6% in U.S. assets and you're borrowing at near 0%, that spread becomes the entire game. You're borrowing cheap money and buying higher returning assets. That flow has been a huge source of buying power in the U.S. market in 2024, 2023, 2022, and the years before. So the concern is straightforward. If Japan raises rates and cools down stimulus, that carry trade shrinks. That means less cheap money coming into U.S. assets. That means fewer buyers pushing prices higher. That means the U.S. stock market feels it. Quick note before I go further. If you want to become the kind of investor who actually knows what to do when headlines hit, that's exactly what the Buffett Academy is for. You get exclusive weekly videos showing the exact stocks I'm buying and why, plus the Millionaire Blueprint, how to build a real portfolio, spot opportunities early, and take advantage of them to make money. The goal is simple. give you the skill set, the process, and the mindset to think like a top 1% investor instead of reacting like everyone else. It's linked in the pinned comment below. Now back to Japan. The second reason this matters is the Japanese housing market and the way their mortgages work. In Japan, 79% of mortgages are variable rate mortgages. Compare that to under 10% here in the United States. So if interest rates keep going up in Japan, and right now they have the highest interest rates they've seen in about 30 years, that means homeowners with variable rates will face higher payments. And if they don't have the income to handle those higher payments, that leads to stress in the system. That leads to defaults. That leads to foreclosures. And we've seen what that looks like in the United States during the 2008 crash when housing stress spreads into the financial system. And the third reason, this is the one a lot of people don't fully appreciate, Japan is the largest foreign owner of U.S. dollars and U.S. treasuries. Japan owns about $1.2 trillion of U.S. government debt. And one of the reasons for that is simple. If you're an investor in Japan and you're trying to decide where to park your money, and your own government is paying you a negative interest rate, while the U.S. government is paying you a positive interest rate, you go where the return is. It's not a massive return, but a few percent is still a lot better than negative. But here's the shift. If Japan keeps raising rates, Japan starts paying real positive returns closer to what U.S. government debt offers. So now Japanese investors look at the world differently. Instead of automatically pushing money into U.S. treasuries, they have a strong reason to keep that money at home. And that creates pressure in the United States because treasury yields are set by supply and demand. When there are more lenders buying U.S. government debt, the U.S. doesn't have to offer as high of an interest rate to attract buyers. When there are fewer lenders, the U.S. has to raise rates to incentivize people to lend. And that matters for everyone, not just bond traders, because U.S. Treasury yields are the baseline interest rates in our economy. That baseline feeds into mortgage rates, it feeds into car loans, it feeds into credit cards, it feeds into business borrowing, it feeds into basically everything. So if Japan shifts away from buying as many treasuries and yields rise because the U.S. has to compete harder for capital, borrowing gets more expensive across the board here at home. That's why this matters. Now, here's the key. We don't need to guess every detail of what happens next to understand the impact. February 8th is a decision point, and decision points move markets. Japan's path on money printing and rates will ripple into global liquidity, and global liquidity hits the U.S. stock market fast. And we've already seen direct impacts from the Japanese bond market, Japanese stimulus expectations, and changes in interest rates hitting U.S. markets multiple times over the last 12 to 18 months. Now zoom out even further because Japan has another issue sitting under all of this: debt. Japan has a record amount of debt relative to the size of its economy. They're sitting at roughly a 240% debt to GDP ratio. Compare that to the United States, where we're around 120% to 125% debt to GDP. Here in the U.S., you hear about national debt constantly. You hear numbers like 38 trillion. You hear people talk about how big of a problem it is. Japan's problem is roughly twice as big relative to the size of their economy. And now they're looking at printing even more money, more aggressively, to keep stimulating growth. So you've got a country that's been fighting deflation for decades, used extreme policies like negative rates, now has inflation pressure, has massive debt, and is approaching a major policy decision on February 8th that will set expectations for what they do next. And the reason it impacts the United States is threefold. Number one, Japan is a major holder of U.S. dollars and U.S. treasuries, so their behavior matters. Number two, investors have been borrowing yen cheaply and pushing that money into U.S. assets, stocks, crypto, real estate, and that flow matters. And number three, Japan is a major economy, and we live in a globalized world where a shock in one major financial system moves through everything else. So what does this mean for you? It means if you're an investor, You need to understand the opportunity and the shift that's happening inside Japan itself. Because yes, there are changes with rates and stimulus, but there's also a deeper change in how Japan is trying to run its economy and how Japanese companies are being pushed to operate. For a long time, Japan operated more like a stakeholder-first system. Every company has multiple stakeholders. Employees are stakeholders, customers are stakeholders, shareholders are stakeholders. Japan traditionally leaned stakeholder first, meaning companies weren't just obsessed with pumping the stock price at all costs. They prioritized stability, long-term employment, relationships, and balance across stakeholders. Compare that to the United States, which is a shareholder-first system. In the U.S., CEOs have fiduciary duties, legal obligations to shareholders. The job is to grow shareholder value. The incentives, the compensation structures, the whole machine is built around driving the share price. And Japan is shifting. Japan is transitioning toward a more shareholder-focused approach, closer to the U.S. model. That creates opportunity because when a market changes its incentives and its culture around shareholder returns, you see behavior change at the company level. You see capital allocation change. You see buybacks and dividends become more important. You see efficiency and profitability become a bigger focus. So if you believe that shift creates opportunity, you can consider exposure to Japan. There are funds and ETFs that give you access to the Japanese market without you having to pick individual companies one by one. Now listen, investing has risk. You are never guaranteed to make money when you invest. You will lose money at some point. That is part of the game. So always do your own due diligence and never blindly trust a random person online. My goal is to help you understand what's happening in the economy so you make better decisions for yourself. Because changes happen, and some things will be right for you, and some things won't be. And at the end of the day, the reality is simple. Investors win in this economic system over the long run. That's how the system is designed. Unfortunately, most people are never taught this, but time and time again, the people who consistently participate, who own assets, are the ones who benefit as the system evolves. So the way you win is by investing somewhere. It doesn't matter where you start. What matters is that you start. And diversification across assets, real estate, stocks, crypto, gold, even startups, is how you protect yourself across asset cycles and economic cycles. Markets move up, markets move down, and different assets move at different speeds at different times. So instead of trying to perfectly time the market, own the market. You don't need to predict tomorrow to build a strong long-term position. You need exposure, discipline, and a strategy that survives different environments. Now, if you want to go deeper and you want the exact framework I use to research and buy stocks, plus the exact stocks I'm buying, this is where the Buffett Academy comes in. Inside, you get exclusive weekly videos breaking down the market in real time, showing the exact stocks I'm buying, and walking you through the millionaire blueprint, how to build wealth step by step, how to spot opportunity early, and how to think like a top investor. So if you want that, check out the Buffett Academy. And if this helped you understand what's coming on February 8th and why Japan's decision will hit the US dollar and the US stock market, do two things for me. Hit the subscribe button so you don't miss the next breakdown, and share this with a friend, family member, colleague, or another investor, because the best thank you is always a referral. And the more people who understand how this actually works, the better decisions they make.